My name's James Marley, and today I'm joined by Robert Mead, who is the co-head of Asia Pacific Portfolio Management at PIMCO, and we're going to be talking about all things core bonds. Rob, thanks very much for coming in. Great to catch up.
It's a pleasure, James. Good to see you.
Now, nearly 23 years working at PIMCO. I'm going to be drawing on every ounce, year and day of that experience to help our audience understand what's going on in the fixed income space. But let's start big picture. I read PIMCO's latest secular outlook, which is titled The Fragmentation Era. It talks about the increased involvement of politics in driving economies. I was hoping you could maybe unpack that for our audience and explain why it matters.
It's a pretty simple thesis in reality, but I think it's a really important one for investors. And it's really thinking about sort of changing alliances around the globe, whether it be based on trade, security, or even just an economic alliance, and how those are all in a state of flux. And so obviously Trump 2.0, there's a slightly different focus in terms of how different countries need to think about defence, need to think about trade. We know that we've got a sort of daily news flow that's quite random at times, or it feels random at times. And I guess the most important takeaway is maybe the end of the US exceptionalism. So thinking about global diversification in portfolios, thinking about where assets are currently priced versus this backdrop of changing dynamics and arguably much higher volatility. So just sort of thinking that through in a portfolio context rather than just thinking we're in the same old status quo that we were in for the last 30, 40 years.
Yeah. I know there's been a few little bumps along the way, but my observation is generally against that changing backdrop that you've described, bond markets have been reasonably well behaved. Is that a fair observation?
Behaved, yes. There hasn't been too many periods of extreme volatility. But when you start to calibrate, and we'll talk about this a lot more, is when you sort of recalibrate just how far rates have moved, it's quite stunning. So 10-year bond yield in the US around 4.5%, 30-year yield now north of 5%. It was only 3 years ago, like through the pandemic period, where 30-year bond yield in the US was 1.5. Now it's 5, right? So yields have moved a long way. Part of that's a reflection of that backdrop, that inflation came. It's now sort of disappearing, at least at the margin. And you had these issues around debt sustainability, just the amount of government bonds that are being issued. All these things started to become a really important phenomenon that investors had to deal with. So yes, they've been quite well behaved, but yields are actually pretty high now.
What's the take on the sustainability of government debt out there, and what are some of your base cases around how that plays out? Because there has been a lot of concern and talk around the levels of debt, particularly say over in the US.
Yeah, I think it's a great question. And if you think about what the measure of sustainability is, if the measure is can highly indebted governments continue to get funded, yes, debt is sustainable. It is sustainable. There will be a buyer base that is willing to fund most governments. The question just comes down to what price do they have to pay for that debt, and so that comes back to those yield levels. There's no surprise that when you run big fiscal deficits, interest rates go up, yield curves steepen, as investors want more premium for uncertainty or more premium for increased supply, and so. When coming back to that sort of 30-year yield number of north of 5, that's already reflecting what the market can see is coming down the pike in terms of issuance. I guess the bigger concern though is when you already have large amounts of government debt outstanding and overlay that with big government deficits, is that we're in quite a positive growth world, and we're still running large deficits, especially in the US. So what's left in terms of firepower when we start to go over the other side of the sort of the growth trajectory and we end up in recession? Just means there's a lot less degrees of freedom. Yeah, that's what it probably means. It means that the central banks have to do all the heavy lifting again because the fiscal authorities have less firepower given that they're already running large deficits, especially in the US.
Yep. And is there a connection between what we've just discussed there and how investors think about their bond portfolios?
I think so. Again, it's one of these things where you need to be forward-looking in every market, and looking in the rear vision mirror in 2023 wasn't really going to tell you anything about expected bond returns going forward. You need to think forward. And so have investors pivoted enough based on this complete repricing of yields? No, they haven't. Nowhere near. I think there's a lot more portfolio rebalancing that needs to happen, and hopefully that theme continues over the coming quarters and years.
Okay, well, let's look away from the rear vision mirror, look out the windscreen. You've talked about that period of rapid adjustment from ultra low to higher interest rates. Where does that put us now, and what does the outlook look like, particularly for core bonds?
One of the great things about core bonds is they're quite simple in terms of how to understand expected returns. So when you look in the rear vision mirror to just only for 1 year back to 2024-25 fiscal year, core bonds return somewhere between 6 and 9. And so investors shouldn't be that surprised. But again, it's not getting much attention, I must admit. Like equities were only up a similar amount, but they seem to get a lot of attention. Core bonds did really well.
It caught my attention when I saw the results. So
yeah, it's
when I saw the index return for core bonds, it sort of blew me away a little bit.
Yeah, that's appreciated, James. I'm glad.
Well done.
Yeah, thank you. But I think it shouldn't be that surprising for investors, given that about 95% of expected returns from core bonds over the next 3 to 5 years is explained by the starting yield. So when starting yields are high, like they are now, it's not surprising if bond returns are also high. And so while we've started into a central bank cutting cycle in most jurisdictions, at the same time, yield curves have been steepening. So the yield across a bond fund is barely changed. So from, say, a year ago. So looking forward, it's actually a pretty rosy picture as well, given these starting yields are high.
And across the spectrum of opportunities, what are you talking to clients about how they can make the most of those higher yields?
Yeah, I think there's a few things. So first of all, given that backdrop of fragmentation, global diversification becomes that much more important. So if you think about tariffs, now tariffs always sort of the next word after someone thinks about tariffs is inflation. And it's true that if you're the country that's putting the tariffs on, it is inflationary, or it's most likely to be inflationary. So it will be inflationary in the US, most likely. Early data suggests that's starting to show up, very, very slightly, but starting. But for the rest of the world, it can be disinflationary. So as a bond investor, that when you want to be thinking about where you're getting the best real returns, the rest of the world's starting to look more attractive than, say, the US, even though US yields are much higher. Yeah. The other thing is just sort of thinking through the amount of volatility in the system and being active to anticipate those changes. And finally, it comes back to that yield curve steepening. So if you do think there's going to be a lot of supply, you do think markets are going to request and require a higher yield to absorb that supply, you want to be further down the yield curve. You want to be around the 5 or 7 year part of the curve, take advantage of the fact that central banks are still cutting and generate some capital gain through this concept of roll down in the curve.
There was some debate, particularly during the pandemic era, about the breakdown of the relationship or the negative correlation between bond and equity returns and the defensive nature or the defensive role that they could play. Has that re-established itself? What's your take there?
If you look at the data over the long run, it's true that when inflation is above central bank targets, correlations of all assets go up. And so we've been in that situation sort of through the whole pandemic and thereafter, where inflation was well above central bank targets and correlations between assets all went up. And so that diversification benefit of bonds versus equities, say, was very weak. Now that we're moving back into this realm where central banks are confident that inflation is within their target range, the benefit of that lower correlation and the benefit of diversification reestablishes itself. And that's where we are right now. To build an efficient portfolio, correlations don't need to be negative, they just need to be low. Yeah. And they're now low. So it's an opportune time to be to be diversifying, not just into bonds, but into sort of a range of different risky assets.
Now, one of the developments we've seen in Australia, which is particularly relevant for fixed income investors, is the phasing out of hybrids. Interested to know, what work have you done at PIMCO about finding a solution, or maybe not a direct replacement, but a way that people can achieve similar style returns to replace that hybrid allocation?
There's been lots of different funds launched, other things as a sort of hybrid replacement. So when we started to see that flow through, we thought, let's sit back and actually do some rigorous analysis to say what's the best solution for an investor that's looking to replace hybrids over the next few years. And when you look at it, there's a couple of really important elements. So the first thing is, part of the attraction of hybrids was not just that they were very risky and they had big spreads on them, they had franking credits. So you don't necessarily want to immediately say we need a similar credit spread or after franking credit spread, because it's way riskier than the hybrid was to begin with. And when we did this analysis, you end up with a situation that you don't need to replace every dollar of hybrids with private credit. You can replace about 25% of your hybrid exposure with privates. And they can be semi-liquid, they can be global, they could be Australian. There's a whole range of different ways to populate that 25%. But I think most importantly, the other 75% of the replacement in a sort of after-tax yield portfolio that has the same expected yields as a hybrid is in multi-sector credit, it's in core bonds, it's in ETFs, it's in daily liquid opportunities and instruments. Yeah. So it's 25 private, 75 highly liquid. You don't need to replace it with other things like Aussie stocks that have franking credits. You can do other things. And the outcome of that is you end up with a portfolio that has a similar yield expectation to a hybrid, but actually less risk. So it's, again, part of that good news story is the fact that yields are already high. Yep. If yields were low and curves were flat, you wouldn't be able to replace them so easily. But at the moment, given the level of yields, they're quite easily replaced in a portfolio, and investors can lock away that yield for like 7 to 10 years. So it's really compelling.
As I mentioned in my introduction, you've been over 2 decades at PIMCO. The world has changed a lot in that time, but in particular, financial markets evolve, solutions available to investors take steps forward. What do you think are 2 or 3 developments in the fixed income space that you've observed over your time that result in better outcomes, or that are positive steps forward for investors?
Yeah, I think let me set the backdrop, and I guess I'm a glutton for punishment for being in the bond market for all this time. But when I first came back to Oz in 2007, like within 2 years, we were bang into the GFC. Interest rates were on their way to zero. Quantitative easing, all those concepts was something that everyone talked about. And then we had a sort of half-hearted attempt to have yields go back up, sort of 2018, 19. And then bang, we were hit with a pandemic, yields back to zero. So it's only now, really in the last 2 years, throughout that entire period, since I've been back in Australia, that yields have now returned to levels that are attractive. It's taken that long, almost a couple of decades had to go by. But now bonds can actually do what they're supposed to do. They can provide income to investors. They provide defense because they will be lowly correlated. They can, very, very importantly, provide resilience in portfolios. So all of these things that bonds were supposed to have done over all these years, and they were unable to do because yields were so low, now they can do that in a portfolio context. And I think the other really important thing through that period is the Australian bond market has evolved tremendously. It's gone from a market that was barely needed because the government was running surpluses to something that's truly vibrant. It trades actively. It's literally in the hundreds of billions of dollars in most sectors, adding up to like well over $1 trillion. The biggest changes we've seen through there is state governments have been heavy borrowers, much heavier borrowers than the Commonwealth, so spreads are very attractive. We've seen the corporate market beef up tremendously, primary markets active every single day. And one of the things that's probably lesser known is the RMBS sector in Australia. It was the second largest market in the entire world for issuance last year. So investors don't need to look that far afield.
We do love the housing market.
Oh, we do for sure. And so that's showing up in sort of non-bank origination and all of this structured credit, which is extremely attractive. And again, when I first came back, it was a tiny market that would barely show up on a pie chart, now being the second largest in the world in terms of issuance. So tremendous opportunity, complete change in the backdrop of how investors can create alpha in portfolios.
Yep. Just a final point. When I spoke with your colleague Adam Bowe this time last year, he was banging the table about the opportunity in bonds, coming off a good year. How would you, I guess, position where we sit today in terms of the opportunity for bonds going forward?
Yeah, so I'd go back to the earlier comment around, and Adam nailed it, by the way, last year, to sort of just making it clear that these starting yields are so important. So looking forward, I think it's almost a two-pronged approach. So the first thing is the underlying beta of the asset class will generate attractive returns. It will be sort of lowly correlated, as I mentioned. But given this backdrop of volatility that we spoke about, if you're an active manager with lots of different tools to deploy in terms of how to position in the bond market, there's also this great alpha generating opportunity well above the underlying beta. So it's a pretty good story at the moment.
Okay. Well, Rob, thanks very much for coming in and being part of our income series this year. It's been great to catch up and a pleasure to have you in here at Livewire.
My pleasure too. Thank you.
Ladies and gentlemen, I hope you enjoyed that interview with Robert Mead, co-head of Asia Pacific Portfolio Management at PIMCO. Remember, check out our YouTube channel and the income series on Livewire. We've got fresh content like this dropping every week.